All right, my clock shows 10 o'clock. I think we can get started here. Good morning, everyone. It's time for another DWD not-for-profit webinar. Today, we're going to cover internal controls. Before we get started, I want to take a moment to introduce our not-for-profit team. My name is Tyson Moore. I'm accounting supervisor in the not-for-profit division. Joining us today are Phil McKenzie and our presenter, Carrie Minnick. Before we get started, I do have a couple of housekeeping items to cover. So this webinar is live, it's interactive. So for those of you who have questions during today's webinar, please use Zoom's question and answer feature. You should find that at the toolbar at the bottom of your screen. We'll also be answering questions periodically throughout the presentation. Also, Carrie's slides will be emailed to everyone attending the webinar today, along with being posted to our website after the presentation is finished. All right, with that being said, I'll turn it over to Carrie to get us started.
Thanks, Tyson. Today, we're going to talk about controls. And to start off with, I just wanted to share this quote the statement from the Association of Certified Fraud Examiners from their 2020 report to the nations. Nonprofit organizations have fewer anti-fraud controls in practice, leaving them more vulnerable to fraud. So something to kind of think about within your own organization, how many controls do you have in place? There are some common vulnerabilities that nonprofits have due to the way nonprofit organizations are. Limited personnel, limited resources, your executive director, your CEO is stretched too thin, volunteer board, or maybe your board, obviously they have their own jobs, everyday things going on. Maybe they have a lack of financial expertise. Maybe you have a disengaged board where they're not, coming to meetings, not participating. The culture surrounding the charitable purpose, the more focus on the mission. And then there's also the theory that small organizations do not need to have internal controls or can't afford them. And this is just simply not true. For small organizations, it is possible to tailor controls to address control risk within the organization in a cost-effective manner. And we're going to go through some of those today. We're first going to talk about some backgrounds with just controls and what they are, and then we'll give you some specific examples that you can apply within your organization. So back to the Association of Certified Fraud Examiners report to the nations. The top 3 control weaknesses for nonprofits: 35% lack of internal control. So they simply just don't have the controls in place. 19% are due to lack of management review. So maybe they have the controls in place, but there's no review. And then 14% override of existing internal controls. The top nonprofit schemes you can see here on the screen, the top with 41% corruption, billing, expense reimbursements, cash schemes, non-cash schemes, skimming. So you can see all the various ways that people could scheme, could create fraud within your organization. And so we want to try and prevent that from happening, or at least put some controls in place that limit that from happening. Detection of fraud at a nonprofit organization. As you can see, these are the top 5 ways that fraud is detected based on the Association of Certified Examiners report. The top way, 40% of the time, it's a tip or a complaint. Then you can see internal audit, management review by accident, or by examination of documents. Now, as you can see on this slide, it does not say independent audit. When we come out and do an audit of your organization, that is not, our purpose of that audit is not to find fraud. Now, obviously, if we see something, we will tell management about it, we have to address it. But the purpose of an audit is not to find fraud. So I know I've heard that oftentimes before, where an organization wants to have an audit done to make sure there's no fraud. That is just not really a true statement. Again, an audit does a lot of good things for your organization, but its purpose is not to find fraud. So we need to figure out what can be done to prevent fraud within your organization. So first of all, we need to know who is responsible for this. Those charged with governance, your board of directors. They should assume the overall responsibility for the organization's internal control strategy, policy, system, and act accordingly. Again, they are the ones that are ultimately responsible for your organization. management should design, implement, monitor, evaluate, and report on the organization's internal control system in accordance with the internal control policies and procedures as approved by the board. So again, the board is approving it. They need to have a knowledge of what's going on. Management's the one that is actually implementing it. Employees, they need to be held accountable for proper understanding and execution of internal controls within their job responsibilities. So we'll talk about that a little bit later, communicating. So obviously the controls will not work unless you actually communicate those with your employees. You really need to have buy-in from everyone for these controls to work. And then obviously volunteers, more specifically finance committee within the board of directors. So really, there's a lot of different people that have a responsibility in participating in internal controls and making sure that they are implemented, effective, and working. So here's some key areas, key comments as to the importance of controls. Obviously, they're going to safeguard assets and resources. So we don't want people coming in and taking your assets, your cash, your investments. They can help detect or deter fraud. They're going to improve the reliability of financial reporting. So if you have controls in place to make sure that your transactions are recorded properly within your accounting system, they're going to reduce the risk of errors or misstatements in financial reporting. Obviously, we want to make sure that we are complying with all rules, regulations, requirements that we have as a nonprofit organization. They're also going to demonstrate accountability as stewards of the organization's resources. If your organization has internal controls in place and shows, that tone at the top that controls are important, that really demonstrates a good accountability, not only to your volunteers, employees, but also to the community at large. And then again, just supporting the organization and achieving its overall mission. So what is the definition of an internal control? Well, an internal control is a process that is effected by an entity's board of directors, management, and other personnel, as we talked about, all of those involved within the organization, designed to provide reasonable assurance. We're not talking about absolute, but reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. When we think about internal controls, we need to remember that people are involved in this process. People affect processes. So you can put internal controls into place and you can communicate them, but you have to make sure that the people involved have a buy-in, understand the controls, and follow the controls. Some of you that we work with directly performing audits probably are familiar with the COSO questionnaire that we asked you to fill out. And I'm not going to go, there's like legislature and a bunch of information on the Committee of Sponsoring Organizations of the Treadway Commission. I just want you to be aware that there is an organization out there. It's actually a joint initiative of 5 organizations that developed a framework and guidance to help organizations design and implement internal controls. So this is really a way to apply internal controls to any type of organization, whether you're a large organization or a small organization, it applies to you. Whatever your mission is, whatever the size of the organization, you can apply these controls. And they have it divided into 5 different sections: control environment, risk assessment, control activities, information and communication, and monitoring activities. So again, these are kind of the 5 different components of internal control, and then they are broken down into various concepts, as you can see under each of these sections. And we will dive into this a little bit later. So the 5 components of internal control that we talked about, let's look at them individually. So control environment. So what is your tone at the top? Does management take control seriously? Does your board of directors, your executive director, do they think that it is important for your organization to have internal controls in place? Pretty easy. Risk assessment. Has management identified risky areas and implemented controls? So do you talk about the risks that your organization may encounter? And then what controls can offset those risks? Control activities. Are there policies and procedures in place to prevent these from happening? information and communication. Are the technology, accounting, and communication systems and processes understood? So again, are you communicating these controls to your employees, your volunteers, your other board members to make sure that they understand and so that they can carry out those controls? And then finally, monitoring. Are the policies and procedures working? Because if you go and take the time to set up all of these controls, communicate these internal controls, but you don't monitor them to see if they're working, it really defeats the whole purpose. So again, the easiest thing that you can do is start with your organization's culture. Let's look at the tone at the top. If your employees are expected to submit receipts for a reimbursement, then you need to make sure that your executive director, your CEO, that top C-suite are also expected to do the same thing. They are really setting the tone for the overall culture of the organization. You want to make sure that your leaders model the behavior that they expect to get from the employees and volunteers. One way you can do this is to implement a code of conduct. So you can have a separate document that is a code of conduct, or many organizations will include this in your employee handbook or personnel manual. That's fine. And you also want to reinforce transparency. So if someone thinks something is happening or they hear something, you want to make sure that you have a whistleblower policy in place. If you do not have a whistleblower policy in place and would like a copy of one, please let us know. We can provide you with that. And then also a conflict of interest policy. Conflict of interest policy is used to disclose any potential conflicts that may arise when an organization does business with related parties, or in instances where someone may benefit from the relationship. So if you do not currently have a whistleblower policy or conflict of interest policy in place, I would highly recommend putting those into place. So let's talk about risk assessment. Your organization probably already addresses some risk, but it's probably done in a siloed approach. For example, you probably look at your IT, your technology, or your finance, or maybe for some type of accreditation. They probably each department probably does their own. But when each person or each department does their own, you're really missing out on an organizational wide assessment. Looking at the organization as a whole to identify risks in achieving your mission. So a risk is any adverse event that could prevent you from achieving your mission. So what kind of risks are there within nonprofit organizations? So I've listed some possible risks on the screen, and obviously this is not all inclusive. Some of these risks may not apply to your organization, but these are very popular ones that most organizations do face. For example, revenue concentration. If you receive a large amount of your revenue from a single source or a single type of revenue, you might have a risk where if that revenue source suddenly goes away, your organization may not be able to survive. So if you think about where you're getting your resources from, who is paying you? Is it a single donor that you're relying on, a single foundation? Is it a single government entity, or maybe it's all government money, or maybe it's a significant amount of program service revenue from a specific program? When you're looking to see where your revenue is coming from, think about, okay, if we lost this funder, if we lost the checks, the payments from this payee, what would happen? Would we be able to survive? If we can't, or if it has a significant effect on our operations, then that's probably a risk within your organization that you should probably look at and address. Compliance. As a nonprofit, there's a lot of compliance that we have to work with, whether it be through grants, the government entities, or other hierarchy organizations that we have to report to. What kind of compliance do we have to deal with? Are we meeting those requirements? Are there certain situations or certain aspects that within our organization aren't set up right to meet those compliance requirements? So making sure that you understand what those are and if and how we are meeting them as an organization. Segregation of duties is a big one. Many organizations they're small or their accounting staff is small. And I know when we work with a lot of nonprofit organizations doing audits and we do walkthroughs, we look at segregation of duties. You want to be able to segregate your duties as much as possible with the staff that you have. Obviously, many organizations don't have the capability to go out and hire 8 additional accounting staff, financial staff to add to you so that you can segregate everything within your organization. We understand that. So what you need to do is look to see what you currently have and what risks are there. Do we need to maybe involve some other people? Do we need to involve the board of directors? And we will talk about a little bit later about different things that you can do to segregate duties as much as you can with a 2, a 3, and a 4-person staff, which talks about staffing. So what risks are related to our staffing? Are we fully staffed? Do we have the right people? Are they overloaded? Is there a risk of us losing staffing? Do we have people that need to have certain certifications? All of that type of thing. And along with that is volunteers. Many organizations rely heavily on volunteers to do the work of the organization. Do you have a proper amount of volunteers? Do the volunteers understand what they are supposed to be doing? The controls that are in place. Security, just general security within your organization. Are things locked up? Who has access to different areas within the organization or different documents, both physically and then also electronically? There's a lot related around electronic access, data records, those type of things. Restricted funds within an organization. A lot of nonprofits receive donations from individuals, foundations that are restricted for a specific purpose. So making sure that those are spent for that specific purpose, making sure that you are able to have enough expenses to spend those gifts for that purpose. And then finally, your reputation. Your reputation is your most valuable asset. If somebody does something to ruin your reputation, it is going to be very difficult to restore that. So I always recommend that organizations go out there and Google themselves. If you Google your organization, what are you finding out there on the internet? So again, these are just some possible risks that many nonprofits face. So in order to address the risks that your organization face, you have to know what they are. And those are some of the ones that we just addressed. You also have to remember that you're not going to be able to address every risk. You can't just come up, okay, here's all the risks. We're going to do this, this, this. You can't do it. There's not enough time. There's not enough energy. There's not enough resources to address every risk. However, you can't ignore risks. You have to be able to prioritize and realign your resources to the highest risks and then go from there. There isn't one way to do risk management, but you have to start somewhere, and that somewhere is with a conversation. So getting the right people within your organization together to talk about, okay, what are the risks that we have within our organization? And again, doing it not necessarily as a siloed approach, but getting the right people. Your CEO, do you need somebody from the fund development? Do you need somebody from IT, someone from programs? Bringing all of those people together so they can talk about it as a whole, and you will probably learn a lot from the different individuals within those different departments. As part of the risk assessment process, we talk about the fraud triangle, and you can see here the 3 areas that make that up. We have the pressure, opportunity, and rationalization. So pressure, who is putting pressure on an individual or the organization to commit fraud? Maybe a CEO or even better, like maybe a fund development person has pressure to raise a certain number of new donors or a dollar amount of donors. So because they have that pressure, they could be more likely to falsify records, maybe put some, false pledge forms in there because they're receiving that pressure. Opportunity has to do a lot with lack of oversight. So if an individual has the opportunity to commit fraud where no one is looking over their shoulder, there's no review process in place, fraud may happen. And then rationalization. And that's where someone is rationalizing why it's okay for them to commit fraud. fraud. So maybe they know that the organization has a large endowment or they have a large cash balance. Well, they won't miss it. It's fine. Or maybe as an employee with a nonprofit, your salary might not be as high as a for-profit counterpart. And so you think you deserve more than what you're getting paid. And so you're just going to take, maybe submit a little extra on that next employee reimbursement. So that's the rationalization. So when you have all of three of these in place, the pressure, opportunity, and rationalization, fraud is more likely to occur. And so what we're going to talk about next is specific controls to limit the possibility for the pressure, opportunity, and rationalization to all occur and to kind of limit the fraud that may happen within your organization. Okay, so as we go through this, it's kind of divided into different sections. So first of all, we're going to talk about bank accounts. So here are some controls that you can consider if you don't already have them in place related to bank accounts. How many bank accounts do you have? The more bank accounts you have, the more risk that you have that someone could access those bank accounts and take the organization's money, just because there's more of them. So limit the number of bank accounts that you have. Who has access to not only signing checks, but online access? Again, the more people that have access, the more risk associated with that. Now, I understand that your organization is probably going to have more than one bank account, and that's perfectly fine. You're going to have more than one check signer. That's perfectly fine. You just need to make sure review those. Who has access? How many accounts do you have? And is it the proper number? Make sure that when you're writing checks out and, receiving bank statements, that's in the entity's name and address, not an individual. Please, if you don't do anything else, please do prepare your monthly bank reconciliations and then also review them, have somebody else review them. So one person is going to prepare your bank reconciliations each month, timely within a reasonable number of days after the end of the month. And then someone else is going to review those monthly reconciliations. And when they review those monthly reconciliations, they need to actually sign and date it to make sure that it happened. And when they are reviewing the monthly reconciliations, you really need to also look not only at the reconciliation, but at the bank statement. Look at the checks that have cleared. Some organizations still receive images of cleared checks, which is great. I know some don't. But if you have your cleared checks, look at those. Are the signers of those checks the correct person? Is that the person who's supposed to be signing it? Is that their signature? And then also look at the reconciling items on the bank reconciliations. Do those look reasonable? Because that's one way that fraud or manipulation of the bank account could occur, is through unreasonable reconciling items that really shouldn't be there. Something else to consider is you should have one bank account for one GL account. Not only will it make the reconciliation much easier each month, it just makes it's cleaner, it's easier to track what goes through the bank. So if you have one bank account with PNC, then you should PNC checking, then on your GL, it should say PNC checking or Three Rivers or whoever you bank with. So one bank account equals one GL, general ledger account. I know some organizations will have one bank account and they will have multiple general ledger accounts to try and track restricted cash and that type of thing. That's one way to do it. However, when you do that, it's more chances of muddying stuff up, not recording transactions properly, just a higher risk. Limit access to blank checks. So whoever has the check stock needs to make sure that that is locked up. Only the correct individuals are able to access that. Bonding insurance for those employees that handle cash and checks. And I'm going to say this a few times throughout today's presentations, please do not use debit cards. Debit cards are essentially the same as cash. It's such a large amount of risk when your organization uses debit cards. I understand that you need to have something to quickly make a payment electronically, use a credit card. There are many more limitations and restrictions on a credit card than on a debit card. If you have a debit card, that person basically has access to your your checking account, and they can do withdrawals, they can make payments to whoever they want to. So please do not use debit cards. All right, so moving on, we talked about cash and bank accounts. So let's talk about receipts. So money coming in. So handling of cash receipts should be independent of accounting. So you should have, and again, I'll give you some examples later about segregating duties, but just making sure that someone else opens the mail, someone else takes the deposits to the bank, and then someone in accounting is actually recording it. So segregating those duties so that, because the risk there is that a check or money coming into the organization is not going to make it into the organization's bank account. Someone within that process is going to have the opportunity, because there's not the responsibilities aren't segregated enough, to take that check and deposit it into their own bank account. And I understand the check is made out to a certain organization. That's fine. Think those can be manipulated. Banks can still deposit, sign off checks. It's just, yeah. So you just want to make sure that you're segregating those duties as much as possible. When the checks come in, it's a good idea to make a list of the receipts. So a list of all of the checks that came in. And again, that is someone outside of the accounting record, or accounting access to the accounting records. So then that list of the receipts can be compared to when the bank reconciliation is reviewed, to make sure that all of the money initially coming in the door was actually deposited into the bank account. Immediate endorsement of all receipts. So stamping the back of the checks for deposit only. Make sure that you're depositing revenue timely. We don't want to get a bunch of checks in and then have them sit in someone's desk drawer for 2 weeks, especially if there are large checks, because again, that just increases the risk that someone that's not supposed to have access to those checks gets access to them. Make sure you send letters, thank you letters, to your donors. Many donors expect that, so that's just kind of an additional way to confirm that, yes, donor, we did get your check. Thank you very much. If a donor does not get a thank you letter, they may reach out because they need that documentation for their taxes. And then that's kind of an outside way to say, hey, you sent us a check, but it didn't get deposited into our bank account. Why? And then finally, reconcile your donor database with the contribution revenue. Oftentimes the development department and the accounting department don't always have the same information, just because of the way accounting rules require contributions, pledges to be recorded. So you need to make sure that you are reconciling these on a regular basis. Also making sure that, again, you're tracking those donor restricted gifts to make sure that they are spent for what the restricted purpose is for. Real quick on federal grants and grants. Obviously, if your organization gets grants, there's controls that you should have in place as far as making sure that the grant application is done properly, any follow-up grant reports are done, the money is spent for what it's supposed to be, that type of thing. But if you get federal grants, especially if you spend more than $750,000 of federal money within a year, you have to have a special single audit done. And there's a lot of additional work and controls that need to be put into place. When we do that single audit, we're going to come in and test your controls over those grants. And so just making sure that if you do get federal money, grants from the federal government, or even the state and local government entities, you make sure that you are clearly aware of what needs to be done with those. These next couple of slides, I'm not going to go through them, but you can see, like, when we do testing of a single audit for those government grants, we're going to look at compliance requirements, making sure that what the money is supposed to be received for and spent for was actually followed through with that. And when we do that, you can see there's all these different areas that we look at: activities allowed or unallowed, allowable costs, and so on. So making sure that you have controls in place to address each one of these bullet point items if you get the federal grants is very important. The Office of Management and Budget issues a compliance supplement each year, and that's what we use to determine the testing that's done for federal grants. So again, if you get federal money and government money, make sure you are very familiar, understanding what the requirements are, and that you have controls over those grants to make sure they are spent for what they're supposed to be spent for. So again, the next couple of slides just kind of give a little bit more detail into each one of those areas, making sure that, again, that it's spent for what it's supposed to be spent for under activities allowed or disallowed, allowable cost, managing the cash, eligibility, if people are being serviced, that they meet the eligibility requirements. There's a lot of controls over equipment, purchasing fixed assets, matching level, period of performance, making sure it's done within a certain time frame. Procurement, program income, reporting, subrecipient monitoring. Again, I'm not going to go through all of that in detail, but we will provide you the slides afterwards so you can see that. And again, just making sure that if you do get government money, that you have somebody within your organization that clearly understands the controls that need to be in place over those. Okay, so let's move on to disbursement. So paying money out. When you write checks, make sure that you use pre-numbered checks, because if you start using checks that aren't numbered, or checks, if you're using them out of order, then it makes it very difficult to account for all of the checks. And we want to make sure that we are accounting for every check number to make sure, even if it's voided, we need to track that and make that it's voided, to make sure that someone has not taken one of our checks and used it for something that shouldn't have been used for. You should use checks for all major payments. I know that a lot of organizations are going to electronic payments. That's fine. This comment here is, use checks for major payments as opposed to cash. So, electronic payments are fine. No pre-signed checks. So you don't want to have the check signer sign a bunch of checks that you had that are not completed and filled out to who they're supposed to be paid for with the supporting documentation. Don't issue any checks payable to cash, because again, if you do that, you're basically giving anyone that has that piece of paper, that check, access to your cash. So if you have a petty cash fund that you need to replenish, then you need to put an individual's name on there for them to go and get that. Deface and retain any voided checks. So again, sometimes we have to void a check. If we do that, that's fine. Just make sure you properly void it, write void on it, tear out the signature, make sure you maintain it in your documents. When you're making payments, you should have some kind of supporting documentation for each payment that the organization makes, whether it be an invoice from a vendor or some other type of supporting documentation that needs, preferably from the payee, the person you're paying or the company you're paying, the vendor, that shows how much we're paying, a date, what the service is or what the item is. So you can clearly see that what you're making the payment for is for a reasonable business purpose. This invoice supporting documentation should be provided with the check to the check signer. So that way, when they're signing the check, they can look at it and make sure that it is a reasonable business expense that should be paid. I would recommend not paying from statements from vendors, because if you pay from a statement, it doesn't usually provide the information as to the specifics as to what was being paid for. So if you get a statement, make sure you ask for a detailed invoice that goes with that as well. Also, when you're making payments, disbursements, need to mark the invoice as paid to prevent it from being paid again. A lot of organizations will just have a stamp. If you are paying for a purchase of items, maybe some inventory or some supplies, make sure that you agree the items ordered to those that were actually received. So make sure that okay, we ordered all this, the organization ordered these items, we did receive it, it didn't go to someone else for their own personal use. And then finally, related to disbursements is review classification of expenses for reasonable by function and natural classification. So a lot of times through the disbursements process, it's noted on the invoice or the supporting documentation as to what expense account or what class it's going to go to. So just making sure that when you're recording those disbursements, they go to a reasonable expense. So for example, if you're paying a utility bill, you're putting that to your utility expense, you're not putting it to a payroll account. And then also by function, making sure that if it needs to be allocated to different programs, management general, fundraising, that you have that process in place. Expense reimbursements, this is a big area, a high risk area for fraud, just because they are payments to individuals. Making sure that you require pre-approval. So if someone is going to use the organization's credit card to purchase something, that purchase has been approved beforehand, or if someone is going to, sign up for a conference, that someone approves that before they actually go and pay it. You should have an expense reimbursement form. So if you don't have that in place and need one, let us know. We can provide that to you. So, just a one-page simple form that says who the employee is that's submitting the reimbursement, and then you can list the different transactions that they're being reimbursed for, whether it's, for like hotel, mileage, meals, that needs to be listed on there. They need to attach all original receipts and documentation. If you don't have that, you should have a policy in place as to what happens in those instances. I know sometimes when you drive somewhere and you park in a parking garage, you might not get a receipt. So maybe you say, okay, for that type of thing, you can submit a page that says what the purpose, why you were parking there, the date, the dollar amount, and sign it might be sufficient. So you should have some kind of policy in place. And again, documenting the business purpose for all of those expense reimbursements, just because some mileage travel could easily be looked at as personal. And the whole purpose of this is protecting not only the individuals within the organization, but the organization itself. So if someone were to come in and accuse your organization of, hey, that check that you wrote over there, that looks kind of fishy. That looks like maybe it shouldn't be part of your transactions. And you can say, no, here's the documentation that supports it. It's a reasonable business purpose. And so approved it. So we're documenting it for that purpose. Mileage reimbursements is a big area that's included under expense reimbursements. Make sure that you include the starting destination and ending destination, reason for the travel, number of miles, and your reimbursement rate. The 2023 IRS standard mileage rate is 65.5 cents per mile. That is something that you can use. You don't necessarily have to use that rate, but whatever rate you do use, make sure that it is documented and that you use it consistently. Okay, credit cards. So again, I noted, don't use debit cards. If you want to have a credit card, that's fine, but not debit cards. But if you are using credit cards, you really want to limit the number of credit cards that you have. Obviously, not everybody in your organization needs to have a credit card. So determine who is it that really needs to have a credit card, who has access to the credit card. Sometimes organizations will give credit cards to actual individuals and then they carry the credit card with them. Or sometimes they will have like a credit card within the office and then someone has to check it out. So whatever method you use, you need to document that and have a policy in place. Again, if you don't have a policy in place, let us know. We can help you, provide you with a template to get started. Included in the credit card policy, probably need to include your card limits as to what is the limit on each of these cards. What can the individual purchase? What can they not purchase? I know some organizations will not allow purchases of alcohol. That's fine. That is the organization's choice. So what is allowed and disallowed? And then what is the policy for charges without receipts? So making sure that, all of these charges that go through your credit card need to have some kind of, again, supporting documentation. What happens if there's a charge that you don't have a receipt for? Is that okay? Does it need to be reimbursed by the employee? Like the employee has to pay it themselves because they didn't get a receipt? Is it okay to submit a page that they sign that says, I didn't have a receipt, but this is what it was for? That's up to the organization, but you need to have a policy in place. Again, each transaction on your credit card should have some kind of receipt or supporting documentation that needs to be submitted timely. As part of that credit card policy, you should probably have stated in there as to how soon, after the month or after the transactions, those receipts need to be submitted. And then you also need to have some kind of process in place for credit card statements to be reviewed to make sure that those charges on the statements are reasonable. When you're doing that, advances, make sure that there are no credit card advances, because that right there is opportunity for fraud. Someone using a credit card, taking advances out on the organization, we don't want that. So make sure there's no credit card advances when you're reviewing the credit card statements. Next is payroll. So again, this is a big area of potentially for fraud to occur through ghost employees and incorrect hours, that type of thing. Not all organizations require timesheets, but if you do, especially, most do for hourly or part-time employees, make sure that someone is reviewing and approving those timesheets. The person that does review and approve the timesheets needs to be aware and knowledgeable of the hours and time that these people are supposed to be working. Again, initial and date, making sure that it is documented that review occurred. Payroll registers, once you have processed payroll, making sure that someone reviews the payroll register to make sure that, yes, these are all the employees that should have been paid. Yes, it looks like this is the amount that they should have been paid. And then also withholdings, should there be any withholdings, making sure that all of that looks good. There should be a process in place for changes to payroll, whether it be additional withholdings, maybe somebody decided to participate in health insurance or retirement, pay rate changes, adding or removing employees. There should be some kind of process in place. And these apply, whether you're doing internal payroll or if you're outsourcing payroll, because we know that, outsourced payroll can also have issues. So making sure that you have some kind of policy in place. Utilize direct deposit whenever you can. Again, that direct payment from the organization to employees limits the opportunity for fraud. And use an outside payroll provider also, just because there are a lot of unique things with payroll, making sure that your organization pays payroll taxes properly and does all of that. So making sure that all in time, that the payroll taxes are paid timely, if you have retirement, that those are paid timely and that kind of thing. So just again, making sure you have oversight documentation related to payroll, because the risk there is that of ghost employees. So setting up an individual that isn't really an employee of the organization, having them be paid when it's really not an employee, it's maybe somebody's friend, or they're getting duplicate it's going to their home address. Again, so just making sure that there's controls in place over payroll. Next is financial reporting. So when you're looking at your organization's financials, do you have the right accounts in place? Your detailed chart of accounts. When your organization is providing monthly financials to your board of directors or your management, are you providing the correct detail that they want to look at, that they are able to understand the organization's transactions and to know what went on during the month? Use your budget. Making sure that you're comparing budget to actual, and ask about variances between budget and actual. If something went up or down and you don't know why, ask. Or on the opposite side, maybe something maybe there isn't a variance and you would have expected a variance. So ask in those situations as well, especially during COVID, when all these organizations had these nice budgets for the year, and then COVID hit and everybody was way out of whack. So no one, budget to actual should have been way off on all of those different accounts. And if they weren't, that's really when we should have been questioning things then. Timely comparative financial reports. Again, it means a lot more when you're providing a balance sheet or a P&L, when you're comparing, this year to date to last year to date. It gives more information to the reviewer. And also timely, when you finish the month, making sure that everything is closed, providing those statements to your board and management to review in a timely manner. If it's not prepared timely, if they're not reviewing it timely, then they are not up to date on what the most recent activity of the organization is. That's going to impact their decision making. So they're not always, as a result, then they're not always making decisions on the best and latest information. So just again, making sure that that information is being reported timely to the proper people. Putting a policy and procedures manual in place. Again, if you don't have one of those in place, let us know. We can help you with that. We can provide you with a sample. Putting in a month-end checklist to make sure that everything is recorded properly, and then reviewing journal entries. Journal entries is a huge way that your financial statements can be manipulated. Someone can easily go in and move activity around. They can overstate receivables or understate them, overstate accounts payable or understate them. So journal entries are a huge way that your financial statements can be misstated. So you want to make sure that those are being reviewed at the end of every month. Just go in, print out all the journal entries for the month, give them to someone else, not the person that made the journal entries, but somebody else to look at to make sure that those journal entries are reasonable. You're probably going to see similar journal entries every month. That's fine. If there's a new journal entry, why? Look at the dollar amounts. Do they look reasonable? And again, making sure that that review or initial end dates off that sheet of journal entries to show that it has been done. Next, our technology. Didn't want to get too much into technology, but just to provide a few items related with controls over technology, restricting access. Nonprofits have a ton of information. Donors, you're going to have, their address, their name. You're going to have all kinds of information about donors. You could potentially have a lot of information about clients that you serve. So there is a lot of information, personal information that nonprofits hold, and making sure that that information is restricted and only those individuals that need to have access to it have access to it. And again, this not only relates to paper, but also electronically, the technology. Require strong passwords and IDs. So usernames, logins, make sure everyone has a unique username and login, that we're all not using the same username and login to access QuickBooks, that we each have different ones, and that those get updated every so often. Back up your data off-site in case something happens. Use antivirus software, spam filters and such. You need to train staff on this, making sure that they are aware of what should be done and should not be done, what they should click on, what they should not click on. After the pandemic, a lot of staff started working from home. So that adds an additional risk. What can they access from home or off-site versus in the office? Is there a difference? Can they use a home computer to access information, or does it have to be their work computer? And all of this should be stated in a document, a policy and procedures manual for the organization. And then also finally, review system access logs for suspicious activity. So for example, super easy one, QuickBooks. You can go in and look at the audit report, and you can see all of the transactions, when they were changed, who they changed, who changed them, items that were deleted. So just, reviewing that in all of your other systems as well, so you can see who is going in there and accessing it. When we talk about controls, we talked about some of these already, but making sure you have some certain policies in place. Again, the conflict of interest policy, the whistleblower policy, and then also the banking authority. We didn't talk about this one yet, but who can open and close accounts, who has access to the accounts, who are authorized signers, and who can make transfers. So putting some kind of written policy into place as to who can go in and do those types of things. So segregation of duties, we mentioned that a few different times. So segregation of duties is a key of control activities. We want to, again, segregate duties as much as possible. Duties are separated so that no one person has total control of a transaction from initiation to completion. So when we think about receipts, disbursements, and payroll, those are kind of the key three areas of most organizations, making sure that not one person can do everything related to receipts, everything related to disbursements, or everything related to payroll. An internal control system is only as effective as the employee who must comply with it. So making sure your employees understand their roles and the importance of the controls in place. So again, making sure that we are segregating duties between the authorizing transactions, so approving them, recording the transactions, putting them into the system, and then maintaining custody of the assets, actually having the cash in hand or the cash going out, invoices and such. So the next 3 slides give an example of ways that you can segregate duties between 4, 3, and 2 individuals. Now, these slides specifically have titles. They have executive director, accounting staff, accountant. That does not necessarily need to be the individuals that are actually performing that. If it is, that's great. But when we have accounting staff listed, maybe that's not your accounting staff. Maybe it's a development person. The point is that there are 4 boxes here which represent 4 different people. So using someone else outside of the accounting department, or using a board member, your board treasurer, you can see here this is an example of how you can segregate duties as much as possible between 4 people. And then the next slide here talks about 3 people. So again, we have the executive director, accounting staff, and an accountant. Does not mean that necessarily needs to be an accountant, but again, we want 3 people. And you can see here kind of the different responsibilities that you can divide between these 3 people to have an adequate segregation of duties. And then finally, the 2 people. Obviously, with only 2 people, it's difficult to do that, but here is a way that you could possibly do that. And again, we will provide these slides to you at the end of later today, so you have access to all of that. In order for your controls to work, you go through this whole process, you talk about your risk, you decide what controls you're going to put in place, but people need to know what they are and what part they play in the process. So that is why it's very important to communicate these controls processes to your volunteers, to your employees. So to do that, you need to define their role. What is this individual doing within this process? What are they supposed to do? Set their responsibilities. Your policies and procedures that we talked about, make sure that you, number 1, have them in place, but also they're not just sitting on a shelf somewhere. You have to share those with people to make sure that they get implemented. And then building an active communication into the culture, making sure that someone isn't afraid to ask questions, or if they see something, to speak up. And that kind of goes back to the whistleblower policy. And then finally, monitoring. So it's not just a one and done process. We can't say that, okay, we talked about our risks, we figured out what areas within our organization are risks, we put some controls in place, we're done. That's not how it works. Everything is constantly changing. And we need to make sure that, social, economic, political, regulatory environment, all of this stuff constantly changes. So we need to make sure that all of those changes understand how they are impacting our controls. So this whole process is really a continual process, and it needs to be reviewed regularly. Is it working? So when you have changes in programs, when you have changes in people, facilities, or technology, you probably need to go back and relook at your controls and processes. Is this still applicable? Is this still the best way to address our risks? If you add a second location, that's probably a huge issue where we really need to revamp how we're doing things. Can we just apply this to the second location, or how are we going to interact between the 2 locations now? So making sure that you not only continually monitor, is it working, but when you have significant changes within your organization, how is that impacting? And then finally, some things kind of related more to technology is reviewing system access logs to verify individuals accessing information, which we talked about. Periodically selecting a random transaction to inspect. So you can, as part of our audit process, we come out and we do walkthroughs. So what we do is we randomly or haphazardly select a deposit, a check that was issued, and a payroll. And then we kind of walk through the process to see if what you said, how you do things, is actually how it's done. You can do that yourself. So you can have someone within your organization every so often go through and walk through that process and say, okay, this is how we say it happens. Is this really how it happens? Are we really keeping the proper documentation, noting the approvals? Is that how we are doing it? And that's one way to monitor, and then you can determine, okay, this is working or not working. Make sure that you are keeping up to date job descriptions. Again, it is important that people are communicated with and to what they are supposed to be doing within this process, and making sure that you're actually observing them to see if, okay, yes, this is what they should be doing and this is how they are doing it. And then finally, the independent reconciliations of account balances. So important to reconcile your bank account, your cash accounts every month, because everything goes through cash. But then also to make sure that you are reconciling all of those other other account balances, to make sure that, you know, your fixed asset detail listing agrees to what's in your GL or your receivables. Because again, if people are manipulating things, that could be a way when things aren't tying out, and then you're going to have to do a bunch of journal entries that could lead to potential fraud opportunities. So again, just making sure that it's a continuous process, monitoring it, going through at the beginning, starting with, hey, okay, let's sit down. What are the risks for our organization? What controls do we currently have in place? What controls do we need to put in place? And then making sure that those controls are continuing to work. If you need any of those policies that we talked about today, please let us know. We're happy to provide those to you. And with that, I'm going to turn it back over to Tyson.
Yes, thank you, Carrie. Just as a reminder, this webinar, it was recorded. So the slides and the video are going to be available on our website. It'll be in the not-for-profit section. A link to this section will also be emailed out to everyone that attended today, along with Carrie's slides. While you're on our site, be sure to register for next month's webinar. It'll be on September 14th. We're going to talk about cost allocations. It's really good to see some new faces in the chat, along with some returning viewers. So just remember, our webinars are open to everyone. So feel free to share links with other people in your organization, even your board members. And with that said, I want to thank everyone for joining, and have a good rest of your day.